Good day, everyone. I am Sherifa Clark, Senior Analyst on the team at CCMT Consulting. With me are my teammates Khadija Turner, Andrew Clay, and Jasmine Magruder. Over the next few minutes, our team will walk you through our 5-year plan designed to enhance Oxy's competitive advantage in our rapidly evolving energy landscape. Here's our agenda, but don't worry, these slides will be shared with the group. This is an open forum, so please feel free to ask questions. Oxy's overview. Let's begin with a brief overview of Occidental Petroleum Corporation, or Oxy. Oxy has been an energy leader since 1920 with operations across the US, the Middle East, and North Africa. Known for oil and gas production, chemical manufacturing, and low carbon technology, Oxy is well positioned to lead energy transition. I'll pass it off to Andrew to begin with the company's financial health with a deep dive into Oxy's income statement and cash flow analysis.
Thanks, Sherifa. In 2024, Oxy posted a revenue of $26.73 billion. Earnings have rebounded significantly over the past 5 years since the 2020 pandemic low. However, operating expenses increased to $4 billion in 2024, reflecting higher investment in innovation and infrastructure. One of Oxy's greatest financial strengths lies in its free cash flow, which totaled $4.5 billion in 2024. Let's unpack the cash flow activities that contributed to this $4.5 billion. Operating activities generated a substantial inflow of $11.4 billion in 2024, with a peak of $16.8 billion in 2022. This signals consistent earnings from core business operations. Investing activities reflected large outflows of $14.6 billion in 2024, driven by expansion projects and asset acquisitions. While these negative cash flows may seem concerning, they indicate strategic reinvestment. Financing activities reversed previous trends, moving from significant outflows to a positive $3.84 billion in 2024. This shift suggests strategic borrowing and equity moves to support growth. As a result, the net change in cash was positive at $693 million, reflecting well-managed inflows from operations and financing despite aggressive investment. Oxy effectively manages cash flow to support its strategic objectives while maintaining liquidity. Furthermore, the free cash flow was evenly allocated to $1.5 billion for debt repayment, $1.5 billion for shareholder returns, and $1.5 billion for capital expenditure, with an emphasis on low carbon and CCUS technologies. This free cash flow balance signals financial discipline and strategic foresight. Khadija will now walk you through the balance sheet and key financial ratios.
Thank you, Andrew. So now let's take a look at Oxy's balance sheet. The total assets grew from 80 billion to in 2020 to 85.4 billion in 2024. More impressively, common stock equity nearly doubled from 10.6 billion in 2021 to 25.9 billion in 2024. That signals a very strong investor confidence and internal reinvestment. While total debt stands at 27.1 billion, net debt declined from 30.4 billion in 2020 to 23.1 billion in 2024. thanks to focused debt reduction. So now let's look at some key ratios as of 2024. The current ratio is 1.29, indicating a solid short-term liquidity. Quick ratio of 0.90, indicating conservative liquidity. Debt to equity 1.48, indicating moderate leverage. Shareholders' equity of approximately $34.48 billion. So, what does this all mean? Well, these ratios are indicators that suggest Oxy is in a very strong position to fund growth without over leveraging. Next, Jasmine will break down Oxy's market performance and peer positioning.
Thank you, Khadijah. Let's take a deeper dive look at Oxy's market performance. Since the onset of COVID 19, Oxy has seen dramatic fluctuations in its stock price. In March of 2020, shares dropped to about $12 due to a collapsing global oil demand. By March 2022, the stock rebounded to around $72 during the energy market recovery, driven by increased demand amid global shortages. As of March 2025, the stock sits at approximately $48, a sign of stabilization and investor recalibration. Those movements align closely with three key phases. Phase 1, COVID 19 impacts in 2020. Crude oil demand crashed worldwide, hurting prices and investor confidence across the energy sector. Phase 2, post-pandemic rally from 2021 to 2022. As economies reopened, energy demand surged, causing a sharp rally in oil prices and benefiting producers like Oxy. Phase 3, stabilization phase from 2023 to current. Global markets adjusted. While demand remains steady, the pace of recovery has evened out. Oxy's current price reflects this new normal. Now let's compare Oxy to key peers. Revenue. Oxy's $26.73 billion trails behind COP's $54.74 billion and BP's $189.19 billion, indicating room for top line growth. Free cash flow. Oxy holds $4.52 billion, slightly behind COP's $8.01 billion and BP's $12 billion, but still robust. Receivables turnover. Oxy posts the 7.95 ratio, trailing COP 9.00 and Dow 9.07. While Oxy operates with efficiency, its revenue base and market value lag. Let's examine these dynamics further through a SWOT analysis. Let's look at strengths and weaknesses of our SWOT. Strengths: strong FCF generation, leading low carbon tech like CCUS and DAC, and resilient U.S. shale operations. Weaknesses: smallest revenue base among competitors, mid-tier receivables efficiency, and ongoing market underperformance. Understanding these factors enables strategic planning. Sherifa, now let's discuss our peer-aligned strategic roadmap.
Thank you, Jasmine. Our 5-year plan targets 4 interconnected goals. Goal 1, growth via mergers and acquisitions. We suggest investing approximately 5 billion in acquisitions of sustainability-focused energy companies. We also suggest expanding your revenue base and diversifying energy assets. 2. Innovative research and development. We suggest a 2.5 billion investment into integrating lithium ion tech with CCUS and accelerating the monetization of carbon tech. 3. Global low carbon ops expansion. We suggest developing low carbon operations in Oman, the UAE, and Qatar. We also suggest building climate aligned joint ventures with host governments. Finally, ESG rebranding and investor trust. We suggest tying executive pay to ESG goals and launching a reputation campaign to reposition Oxy as a leader in carbon solutions. I will now go over how these goals translate into execution and impact. To execute this plan, we believe Oxy must phase investment carefully. Year 1 to 2, focus on M&A, initiate R&D pilot projects, and launch internal ESG metrics. Year 3 to 4, expand low carbon sites and enter partnerships in the Gulf and North Africa. And year 5, fully deploy new CCUS infrastructure and launch the ESG brand campaign. Our expected income outcomes include 1, top line growth greater than 15% by year 5. 2, increased investor confidence. 3, higher P&E ratio and market valuation. Khadija will now bring us home with our closing message.
Thank you, Sharifa. In conclusion, stands at the intersection of tradition and transformation. With a very strong balance sheet, disciplined capital strategy, and commitment to innovation, Oxy can become a global leader in sustainable energy. Our 5 year plan is a roadmap for value creation, resilience, and market leadership. On behalf of our team, Sharifa, Andrew, Jasmine, and myself, thank you for watching. We have now concluded our presentation and we welcome your feedback and questions. Thank you.